Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning, everybody. It's Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Managed ETF Portfolios, coming to you with this week's economic and market commentary that was sent out originally for Monday, June 17th, recording this on Thursday, June 20th. I do apologize. We had an audio challenge with the software, and after I had already shut down and I had gone off and got on an airplane to travel for the week to see some clients. And so I do apologize that we had to pull that down. As a reminder, you can find me intra-week if anything special happens on LinkedIn or on Twitter. Presentation you are seeing and or hearing is developed by us, Cantor Fitzgerald Investment Advisors. It is designed to be used with both financial planners and advisors and their clients, but each are expected to make their own investment decisions. Nothing contained in here should be treated as investment advice, tax advice, or recommendation for the purchase or sale of any security. Everything you hear reflects my opinion and my view and does not necessarily reflect the view of Cantor Fitzgerald Investment Advisors, parent affiliates, or even other portfolio managers within the firm. We have this thing that's continuing to happen. Large cap U.S. technology stocks are it. And it's sometimes you see, large cap outperforms small cap and vice versa, or one goes up a little, one goes down a little. But the S&P 500, which is now dominated by technology. When I started in the industry in 1987, the largest industry was energy. Energy as a percentage of the S&P 500 today is less than 3%. Tech, that's where the earnings are. That's where growth is coming from, and that is where the market participants are voting and buying and driving up prices. Mid and small cap stocks actually down on the week, and small cap down big. That's a divergence, 4.6 to 1.7 down. I don't think I've ever seen a weekly divergence that big. Now, that may represent some opportunities, which we'll look at as an investment team back here. International markets down. Fixed income got a bit as feelings about when the Fed will cut interest rates began to move to the forefront. It began to be pulled forward. As you remember, I've been saying for some time, not likely to have a cut this year. The data doesn't warrant it. That all changed last week. I now believe they could cut now, but they won't cut now. We're going to talk about that as we progress through. First, let's go through the economic data. Some of the economic data for last week, starting with small business optimism from the National Federation of Independent Business. It remains very anemic for the month of May. It came in at 90.5. It was a little above the consensus estimate, but it was also the highest reading of 2024. People that responded to the survey saying they believe the economy is going to start to improve. However, if you go back prior to the pandemic, you can see readings in this were significantly higher. That was sentiment among independent business owners. Sentiment among consumers, citizens, is different. University of Michigan consumer sentiment came in at 65.6. You can see over here on the right, well below the consensus estimate of 72, down from 69. It's the lowest reading in 7 months. Why? Consumers, the lower you are on the earnings and asset spectrum of our country, the more the inflation hurts you. If you own homes and real estate, that sort of mitigates it, right? Real estate is a hard asset. It will react. If you own stocks, gold to a certain degree, Bitcoin to a certain degree, have been helping those. But if you're living paycheck to paycheck and the price of everything's going up, gasoline and energy and eggs and milk and meat and all of these different things, you're really bearing the brunt of that. It's a form of taxation on not the wealthy. Everybody but not the wealthy pays this tax. All right, moving on to the big data from last week. If I could get my slides to advance, there we go. It was the CPI and the PPI. And I'm going to say this now, the inflation story is over. This is fixed. Now, do I seem ahead of myself? Probably. But I'm going to tell you why I think that's the case and why I think the Fed can't say it or won't say it. Let's start with CPI. Month over month, zero. The estimate was for 0.1% increase. You don't need many zeros before bad numbers fall off and more zeros come on, and that year over year number can drop very quickly. Year over year was 3.3. Core, which is more important, up 0.2. Estimate was for 0.3. Year over year, 3.4 versus 3.5 estimate. But look at this. Core goods year over year down 0.4% or 38 basis points. Core services, if you break out all of the components of the CPI, core services has been the biggest driver and the last persistent holdout, keeping these numbers high. Core services all through here where we couldn't get anything to go down, really, core's going down, but it's just services just not coming down. Now, big moderation in May makes me believe, okay, we finally cracked the last holdout that was holding up the numbers. Then you move on the next day and we get PPI. PPI was down 0.2. That's 0.3 off the estimate. The year over year is 2.2 versus an estimate of 2.5. Core 0 versus an estimate of 3. These are big beats. And that's why we saw the bond market rally and interest rates drop, and now mortgage rates have dropped a little bit. And I think this is where the Fed is probably very quietly back in the office, high-fiving each other, saying, hey, I think we've got this. They don't want to come out and say it. They can't really say it. They're going to say, hey, it's going to take time. There's more data. It's only 1 month. And that's all true. But I think they know in their heart of hearts they've taken care of this. But just like in the CPI, it's been services again, biggest contributor. And again, really major progress there when you look through that economic data. Import and export prices both down also for the month of May. That was helpful. And then we move on to initial claims for unemployment. Last summer, you can see here, initial claims for unemployment got to that 230, 240, 250 level. And they're poking their head up again this summer. Is this just a cyclical thing where we're repeating last summer, or is the labor market really weakening? I think the labor market is really weakening. Why do I think that? Well, let's move on here. What do we have here? Household survey shows employment may have peaked. Establishment survey shows continued growth. Okay, so this white line here, total number of those employed versus by the household survey, and the blue line is the establishment survey. So this household survey, you can see total number employed has been kind of fixed for about a year and may even be headed lower. That's why despite all those, you see all those months of job ads, and those are great, but that unemployment rate last month ticked up to 3.9 to 4. And now the Fed has to start thinking about and looking at their other mandate, the other mandate being to foster full employment. Congress gives them the job of maintaining price stability. I think they're feeling, hey, we got this done, but we can't end up destroying. And if we start seeing unemployment go to 4.1 or 4.2, that could pull the rate cuts forward even more. And I think the markets are recognizing it on the next slide here. This is a little bit busy, but let me tell you what we're looking at here. From the Fed meeting that happened last week, they come out with a statement, and then the chairman goes on television and talks to reporters and does a little speech. They say the economic activities continue to expand at a solid pace. True. There has been modest further progress towards the inflation objective. In the prior statement, it said there had been a lack of progress toward that objective. The next time they meet, they probably say that they made significant or further, something even higher than further. They'll continue to run off their balance sheet, which is part of the plan to attack inflation. The long-run median Fed funds rate projection of all voting members actually ticked up a little bit, as did the median unemployment projection ticked up a little bit. So if that unemployment ticks up or the projection ticks up, now they have to start taking action on that side, which would be to cut rates. Interestingly, I said, well, what is the implied Fed fund rate from the world interest rate probability function? Looking at the futures markets, what are people betting? How are people investing their money? And as of last week, you can see the implied Fed funds rate at certain meetings dates is lower, but it's not that much lower. It's even the same for December and January, down 3 basis points. But that's still far different than what we thought it would be in January. So the point here is the market's pretty efficient. This futures market's pretty efficient. And even though we got this great CPI, PPI information on inflation just last week, the markets were kind of prepared for it in the middle of last month. We also got several central banks begin to cut interest rates. The U.S. central bank normally leads in the cycle. We're the first to raise, we're the first to cut. But because the economy has remained resilient in the U.S., very good because of tech, big tech, innovation, earnings, artificial intelligence, demand for semiconductors, because of all of that, our employment has stayed strong, our economy has stayed strong, and therefore we're able to keep the rates higher for a little longer to combat this inflation issue. But last week we had the European Central Bank, the ECB, the Bank of Canada, and actually the Swiss Central Bank, which I forgot to put in the chart. But the Bank of Canada overnight lending rate cut 25 basis point. European Central Bank main refinancing operations rate cut 25 basis points. These are the first cuts in a very long time. March 2020 for Canada, March 2016 for the ECB. We did nothing with our rate, which is fine. And I think it was the right call. Our last cut was March of 2020. And so what I think is likely to happen is the market's going to start calling for, especially if we get another tick up in the unemployment rate or we have another solid CPI, PPI month, or core PCE month. People are start saying, hey, Fed, you can cut. And so I think the Fed wants to maintain its credibility with the public, and it does not want to be seen as cutting ahead of the election to help the incumbent. So I believe the Fed's cut will come November 7th meeting, which is 2 days after the November general election. The other thing, of course, the Fed is doing, as they mentioned in their statements, continuing to run down their balance sheet. This is the amount of money printed when the Fed goes out in the market, buys bonds, buys agencies, buys mortgage-backed securities. They're essentially creating money out of thin air, but they're getting the bonds in return, and they put the bonds on their balance sheet. As those bonds mature, the balance sheet shrinks. If they add to it or subtract it, the balance sheet can shrink or grow. This is their expansion of the balance sheet from COVID. You can see absolutely massive. Got up to about 9 trillion. Now down 1.75 trillion to 7.25 trillion from the peak. That is deprinting money, that is shredding money, that is disinflationary. But we still have a lot more money printed and sloshing around than we did prior to COVID. It's going to take a very long time to get there. So in a sense, the net from before COVID, still quite a bit money floating and sloshing around in the system. Our Fed funds rate has been on hold, 5.5%, and it's been steady here for a very significant amount of time. We started cutting, as you can see, way back here. Started hiking in March of 22, and now it's been steady. It's hiking and steady. That's my headline is incorrect. It's not held steady over 2.5 years. It's hiking and then steady over 2.5 years. Expectations for rate cuts. The market's believing the Fed's going to cut. I now agree. 3 weeks ago, you heard me say, no way, the data didn't support it. Markets are amazing how right they can be. Markets saw these CPI, PPI numbers we got from last week, and now the market is saying the Fed is going to cut rates. So is that good for stocks or is that bad for stocks? Well, let's look at the 5 times the Fed began a rate cut cycle, going back all the way to 1995. Well, 3 months later, you have 1, 2, 3 times where stocks were higher, 2 lower. I would say that's very inconclusive. 6 months out, you've got 2 and 3, also inconclusive, and same with 12 months out. So if you average them out, flat, down 3, up 5.5, there's really not a statistical correlation. There's definitely not a statistical causation. So we have to look at it and say, well, what is this period most like of those other periods? And I want to take the bad periods first. When the dot-com bubble burst, stock valuations were horrifically high, through the roof. It was this new thing called the internet. It was the dot-com bubble. We had to put a ton of money into the system in late 1999 because we were afraid of Y2K. The computers wouldn't work because we were going from 99 to 00. Nobody knew if it was going to work. The Fed was kind of worried. So I don't think this is like that. Although we're starting to get high valuations on tech and AI-related names. In 07, well, we know what that was. That was the global financial crisis brought on by the U.S. housing ridiculousness that took place. So I don't think this cutting cycle is like any of those. Then the 2019, of course, was COVID. I don't think the cutting cycle is like either of those. I think the cutting cycle is more benign. I think it's more like 95 and 98. We have a strong economy. We have the Tax Cut and Jobs Act of 2017 in place. Things are happening that are pretty good. Where's my concern? Well, my concern is most of the components of that Tax Cut and Jobs Act 2017 begin to expire at the end of 2025. Still, all that being said, stocks are not cheap. On current earnings, stocks are trading at 22 times earnings, as measured by the S&P 500. That's versus a long-term average here. You can see about 18. So it's a premium. Does that mean you sell your stocks? No. Does that mean you go way overweight equity to your benchmark? Probably not. And then if you look at on forward earnings, we're at 21 versus historical at 16.5. So this tells me the market's believing interest rates are coming down, right? They're pricing in a lower risk-free rate of return from which you discount to get your present value of equities, or market that could be a little overextended in the short run. If you're a long-term investor, it's not that important. Now, if we start getting at 26, 27 times earnings, then I think you start talking about that bubble and that stretched valuation. Okay, so I am re-recording this. I apologize. Thank you to the listener who called me Sunday night, tracked me down, and said, Herb, are you okay? His name was Tony. I said, what do you mean? He says, well, I'm listening to the commentary, and you sound like you may have had a stroke. Are you okay? I said, what are you talking about? This is this interesting thing about artificial intelligence. My software that I record this with has a feature to enhance the audio, clean up background noise, fix the uhs and ums that people use, and it's artificial intelligence. It's AI. I chose for the first time to use it last week. When I used it, I just figured it was making it better. I did not re-listen to myself, and what it did was it really messed up my voice, and so we had to delete the podcast, re-recording it for you today, Thursday. I thank you for tuning in. We already know we had Empire Retail, Industrial Production, so forth. Initial claims this morning just came out. They were above this number. Housing starts and permits were fine. We've got these flash PMIs, Conference Board, leading economic index tomorrow, which has been continuing to go lower, and then existing home sales. Don't forget, you can listen as a podcast, but the best place to catch me is on the YouTube, because you get these slides and graphs. Just go to YouTube and type in Slaying Bulls and Bears or Herb Morgan. Thank you, and I'll be back again next week.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.